is Chapter 11, Building the Financial Plan. And this chapter focuses on the financial concepts used by entrepreneurs to build a successful business. And it provides an overview of the financial language, the importance of financial planning, and the purpose of each financial statement. And we will look at the key ratios to determine how well the business is doing. We'll also look at how to calculate the break-even point and how cash flow affects the business and how to access capital. And the financial information in this chapter is going to be entered into your financial template that was provided for you, and you can find that in assignment 11. And you will be asked to estimate the key elements of the financial statements, and then the statements will automatically generate the rest of the information for you. And we'll actually, in the second part of this, we'll go through the financial template, and I'll show you how everything works and how to put everything in. We're also going to look at planned sales, markdowns, stock, startup, operating expenses, and other cash expenditures. So now we're going to talk about the importance of the financial picture. And the main financial statements that we're going to look at in this chapter are the cash flow statement, the profit and loss, and the profit and income statement, and the balance sheet. And we'll also look at how to calculate the break-even point. And examples of all of these statements and the break-even point are given in Appendix D of your book, so you can look at those. And preparing financial statements accurately is critical. And this is because the financial statements are used to gauge the financial condition of a business, and they tell a story about its financial health. And almost every decision made about the business has a financial impact. For example, do you have the correct level of inventory? Do you need to hire more sales staff? Do you need to change the merchandise mix? Are you pricing your items too high or too low? Your financial statements can help you determine if these are correct. They also help determine the amount of financing that will be needed to make the business feasible and the type of financing that we'll need. And they also help in determining when the financing needs to be available. The financial statements also help you determine if there will be sufficient cash flow to pay all of your expenses. And also, maintaining good financial records helps prevent catastrophes and stops failure before it happens. Also, maintaining good financial records helps prevent catastrophes and stops failure before it happens. So startup companies have no financial history to go off of, so they must rely on other sources to prepare reliable financial projections and assumptions. And some resources to look at for information are the National Retail Federation, and they provide information on sales and expenses that can be used to project more reliable financials. You can also look at magazines and journal articles. You can also look at the North American Industry Classification System. They provide information on profits and expenses and the financials of competitors and information on employee average pay rates and average hours worked. You can also conduct interviews with retailers to find out the cost and the percentage of cost in relation to sales for their company. And I will also provide you with some different articles and some different websites that have some good information that you can use to help you come up with all of the numbers that you'll need for your financial statements and all your estimates. So looking at some key financial terms, these are some terms that every entrepreneur should have an understanding of. The first is sales or revenue, and this is just the money earned from providing a good or a service. Your expenses will be the cost incurred in operating your business and providing a product, so it's also the cost of goods sold. Assets is any item of economic value that is owned by the business. So this could be if you own a vehicle for the business, if you own the building, it would be any of your displays or your cash wrap or your computer system that you use. And your liabilities or any debts that you have. So that could be your debt to the bank that you owe, credit card debt that you have for the company. While net income is the remaining income after all the expenses have been paid. So after you pay expenses, the net income is the actual amount you make in the end, and that's the main figure you want to look at. Next is owner's equity, and that's the total amount that the owner has invested in the business plus any profits that are retained for the year. Next is your pro forma financial statements. And all pro forma means is your projected financials, and these are going to be included in your financial plan of your business plan. And these will be the income statement, the balance sheet, and the cash flow statement. And they represent the future plans of the business and are the main forms that we're going to use. So first is the income statement, and it's also called the profit and loss statement, and it shows the amount of income for a specific period. And you can see this in Appendix D. Also, the balance sheet is in there, and it shows the financial condition of the company at a point, and it includes the assets, the liabilities, and the net worth. And the last statement is the cash flow statement, and it shows the difference between receivables and expenses, and it's on a monthly basis. The entrepreneur should also be familiar with the following concepts. The first is the cost of goods sold, or the cost of the product and service, and this is just your purchase price that you pay for your goods. So it's not actually what you sell it at, it's the actual price that you paid for it. Because remember, we're always marking up our goods, and that's the final price after it's been marked up. Debt is the money that is loaned to the company that is expected to be repaid. Equity is the amount of money you put into the business that is not repaid. Stock or merchandise is the value of the products to be sold. And the startup costs are the one-time cost in starting the business. And they include deposits, initial marketing, shelving, improvements to the building, and other things. And we're going to have to be able to determine each of these in our financial template, and I'll help you along through that process. So looking at financial outcomes, the financial plan will focus on 3 primary outcomes. It looks at financial performance, cash flow, and profitability. And financial performance looks at how well is the company doing compared to the industry, while cash flow looks at what are the cash needs and are there sufficient sources to meet these needs. And this is the ability to pay obligations as they become due. Profitability will be if the business is operating at a profit. And this is what sustains the business over a period of time and is necessary to pay debt, purchase merchandise, and fund the growth of the business. And profits are determined by subtracting expenses from revenue. And revenue is the money earned from selling products and is equal to the number of units sold times the price per unit. And expenses also affect the profit and are made up of the cost of the goods sold and the operating expenses. So your expenses, your revenue, and your net profit are the projections of the startup business, and they are part of your monthly cash flow statement, your income statement, and your year-end balance sheet. And these statements are used to forecast the ability of the business to achieve profit and cash flow. So these are the 3 basic financial documents that are going to be part of your projected financials or your pro forma statements that will be in your financial plan. So the first one is the cash flow statement, and it reflects all cash flowing in and out of the business each month, and it allows the owner to understand how the business's operations are running and where money is coming from and how it is being spent. And it does not include the future amount of incoming and outgoing cash recorded on credit, so it's different from net income. Next is the income statement or the profit and loss statement, and it's a comparison of the expenses and revenue of a certain period of time, which is usually a year. And it tells how the money the company has made or lost, and it tells how much money the company has made or lost in a year. And it's divided into income and expenses. And last is the balance sheet. And it's a snapshot of the business at any given point. And it shows what the company is worth on paper. It shows the assets and it shows the liabilities. So assets would be cash, inventory, and property, and liabilities would be accounts payable and long-term debt. And it lets the entrepreneur know how assets, liabilities, and net worth are changing, and it must balance. So you need your assets to equal your liabilities plus equity. And these three specific statements will help determine the amount of funds needed to open the doors and keep them open for your business. And they all correspond to one another. And they'll also, as I mentioned, be part of your financial plan. And they'll be part of what we do in the financial template. So now we're going to look at doing your financial planning template. And this is part of assignment 11. And it makes up the financial plan section of the business plan. And we're going to use the 3 pro forma statements that we just talked about. We're also going to look at ratio analysis that's used to gauge the cash needs and the profitability potential of the business. And so, as I mentioned, the financial template is in assignment 1. There's a link to it there. And it's an Excel document with all the statements and forms that will need to be filled out. And so before we get started with that, we're going to look at the financial assumptions. And they're part of the projected financial statements that will be in the financial section of your business plan. And you can look at an example of these is on page 318 and 319 of your textbook. And what these assumptions do is they provide the reader with an explanation of the sources and the thought processes behind the numbers that you have, especially for the cash flow statement. And they also provide an explanation to how the entrepreneur arrived at the numbers that are presented in all of the different statements. And for your financial plan, you'll need to have financial assumptions written to similar to the ones in the appendix, and you need to include all of the expenditures, funding, and sales assumptions that are also shown in Appendix D. And so the first statement that we'll fill out on the template will be the startup cost statement. And it is all the costs that will be incurred to get the doors open. And let me pull it up and I'll tell you more about it. So here's the financial template that we'll be using. And it has instructions that you can read about and go through that tell you exactly how to set it up. And then the first page is real simple. You're going to fill in all of the yellow sections. And so you're going to put in your name, your year opened, your name, your address if you have it, which you will have address because I give you specific locations to choose from. You can use your cell phone number. You can make a pretend email address and then put in the date. And then here, just use 30% for this. So the first thing we're going to look up is our startup cost. And as I mentioned, these are costs that are incurred to get your doors open. And these costs can be one-time or ongoing, such as assets is like your POS system and fixtures. Those would be ongoing because you'll keep those. Other ongoing operating expenses that are not assets would be your rent and your payroll and your advertising. And if you look on page 248 of the book, there's a list of questions to think about when filling out the statement. So what you're going to fill in is you want to fill in equity investments. Remember, that's how much you are actually going to put into the business on your own of money that you've saved up. And then the loan proceedings is how much of a loan you're going to ask for from the bank. And that'll give you your startup cash that you'll have. Next is your initial expenses. So first is your rent deposit, telephone deposit, utilities, and then other deposits that you could have and insurance. And on these, what I did is whatever your rent is, a lot of times you have to pay your first month's rent as your deposit. So whatever your first month's rent is, put that in as your rent deposit. And then these are just estimates for telephone, utilities, and other deposits that you can just use those same ones that I have for your template. And then these, I will give you in the assignment 11 section a reference that is what is considered like industry standard fees that you have for a startup business. And they had some fees for accounting and legal fees and legal filings and sales tax permit. And for the legal filings and the tax sales permit, just use those numbers because those are what they actually cost. And then advertising, these were just kind of estimates that I came up with based off the ones that I've seen off of industry averages. And same thing for training and office supplies. And so once you put in a number, the purple is what's going to generate for you. And if it has a little red mark here, it'll tell you what this is. So it says this number flows from the 6-month merchandising plan, and this is the open stock converted to cost. So we put this in actually in the 6-month merchandising plan. And this will give us our startup expenditures. And there's also capital expenditures. So this was also where I got estimates from the internet that I used to come up with these for a total startup capital expenditures. And so all of these numbers are just being filled in for you. So say I put in a vehicle here at 20,000. See how it changes that number? So it's just it's doing all the formula work for you so you don't have to do that. Okay, now let's go back to our slides. So now we're going to look at the planned sales statement, which is also the work in the Excel worksheet, and it's where you project what the sales will be. And this number can be based on the market size, the cost of the items, the average sale per customer, and the number of customers expected. And there are 3 primary techniques to project sales. But for this class, we're going to use one of the following techniques, which is the first in which you take your rent for the year and you divide it by 0.06 to determine the planned annual sales. And this is because rent should be no more than 6% of your annual sales. So this gives you the amount of sales you'll need in a year to cover at least your major cost. And a second technique that can be used is where you take average sales for the day and times that by the amount of days you're open to determine your annual sales. So an example of this would be if you expect to have at least 15 customers per day with an average sale of say $50. So your annual sales would be $750. So this is where you take average sales per day, which would be 50, and you would times it by 324 days. So that's saying if you aren't open on Sundays, it would be 324 days a year you'd be open. Then your annual sales would be $243,000. And so that's a formula you can use to come up with your annual sales. And I'll go show you what that template looks like as well. Now we're going to look at the planned sales statement that's in Excel, and this is where you project what the sales will be. And this number can be based on the market size, the cost of the items, the average sale per customer, and the number of customers expected. And there are 3 primary techniques that the book mentions that can be used to project sales. But the example or the technique I would say to use would be the average sales for the day, and which is the second technique. And this is where you take average sales for the day and you times it by the amount of days you're open to determine your annual sales. So for example, if you expect that you'll have at least 15 customers per day and an average sale of $50, so your annual sales would be $750 per day. So you would take your average sales per day, which would be $750, and you're going to times it by 324 days, and this will give you an annual sales of $243,000. And you're going to need this in planned sales, because that's where I came up with annual sales. I said, okay, my annual sales need to be close to $243,000. So when I fill in these blue boxes, they need to come up to $243,000. And what you're going to do is you're going to put in each of your classifications. So one of mine was tops, bottoms, accessories, belts and bags, and dresses were my different classifications that I used. And then I just came up with the numbers that got me as close to 243,000 as possible. And also, this is your first 6 months of sales and your second 6 months of sales to make up a year. So I always had more sales in the second 6 months because you would think you would have more customers by then. And then also, remember, you can't, for these percentages, you can't just take, 8,000 and divide it equally and get equal numbers here because that's not realistic. So what I did is they give you an example for a clothing store, and so I just used their percentages and copied and pasted them into my cells. So the only cells that you're going to be filling in for this will be the classification, the total planned sales, and then percentages. And then everything in the purple is going to fill in for you. And so I figured out what my annual sales to be, and then that's how I figured out what to do for the different blue ones and kind of estimated on what those would be. So that's your planned sales.